Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I'm super excited to have you here today. Today is Friday, April 19th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line, and from this podcast. So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. And oh, by the way, this podcast is also available in YouTube format. I've been playing around with that platform for a few weeks now. If you search for Invest with Beachman on YouTube, you should be able to find my channel. And I usually post the same podcast episode about 24 hours after I post it on Substack. So about 24 hours from now, you should be able to find this podcast episode on YouTube. Now on to the meat of this episode. Well, markets have been certainly interesting over the past 2 weeks. If you remember, last week I mentioned that in the absence of any reasonably important macroeconomic information, economic data, stocks are going to be flying up and down in the wind based on news items, press releases, speeches by important or so-called important people, and maybe even geopolitical developments. And certainly things have been heating up in the Middle East with Israel and Iran firing rockets and missiles at each other. And certainly overnight, markets were concerned with this new military action development, but then they calmed down this morning. And as I look at, it's about 11 a.m. Eastern time as I'm recording this podcast episode, and markets in the U.S. seem to be fairly stable, I should say. Oil prices are slightly elevated. Given the military action, one would have expected oil prices to be much higher, but they aren't. And long-term interest rates have dropped. And even as I look at it, the dollar index has also dropped. So in the light of these tensions, these growing tensions in the Middle East, markets today seem to be fairly stable. In terms of macro updates this week, we didn't get too many interesting or important or leading macro updates, at least those that I consider important or leading. We got a few manufacturing index numbers. Those were mixed. Some of them were high, some of them were low. We got jobless claims for the week. That was stagnant in the 200,000 range. In fact, jobless claims have been stagnant in the 200,000 range for months now. So it's really not giving us any kind of leading indication as to what's happening in the jobs market. For the most part, the employment scenario in the U.S. is still fairly strong. We did get some depressing housing data earlier this week. Housing starts are lower. There's less housing buying activity. In general, there aren't that many buyers out there, and sellers are kind of back in their shell as mortgage interest rates are hovering in the 7% rate. And, really, nobody would want to buy a new home or an existing home and pay a 7% mortgage interest rate if you believe that interest rates are going to drop in the next few months. So housing data was a little depressing. It was a down month for the home builders and the housing market in general. Now, Chair Powell, he made some hawkish comments while he was on a trip to Canada earlier this week. That gave some additional concern to investors, and markets continue to be climbing the wall of worry. We talked about the wall of worry last week. There are many reasons why markets could continue to stay worried. Investors and traders sometimes continue to find reasons for worrying about whether markets would fall in the future. So this wall of worry is still hovering around us. Yesterday we got earnings reports from Netflix. That was a pretty decent earnings report, I must say. Although Netflix was punished, the stock seems to be punished today because they're going to stop reporting subscriber numbers. So that's Wall Street's way of saying, if you don't give us the information that we think you should be giving us, we're going to potentially punish your stock. Next week, we've got some very important earnings reports coming out. And I think these earnings reports next week are going to be perhaps make or break for the markets going forward. We've got the three big hyperscalers reporting. We've got Alphabet or Google, we've got Microsoft, and we've got Amazon. And then Meta is also going to be reporting as well next week. So far, S&P 500 earnings reports are coming out to be kind of along the line of consensus estimates. So far, companies that have reported earnings are reporting earnings growth of about 1% for the first quarter this year. This would mark the third straight quarter of year-over-year earnings growth, right? So we started getting earnings growth in the US starting in Q3 last year. And then Q4 was a very positive earnings growth quarter. And so far, Q1 seems to be following that trend as well. All said and done, the index is likely to report year-over-year growth in Q1 of about 7%. This is in line with the 5-year and the 10-year averages. So analysts are expecting Q1 earnings growth in the US among S&P 500 companies on average to be about 7% this quarter. The actual earnings growth rate has exceeded the estimated earnings growth rate for about 37 of the past 40 quarters. So the S&P 500, these 500 companies are arguably some of the best run companies in the world. And they continue to grow, and they continue to grow their top line sales as well as their earnings. And they have done this for the past 37 of the past 40 quarters now. So again, a very, very strong performance record by the S&P 500 companies. The only 3 times in the past 10 years when they did not grow earnings was the Q1 of 2020. That was the COVID pandemic quarter. And then we got Q3 22 and Q4 22. Those were some pretty depressing quarters in terms of growth performance for the S&P 500. But 37 out of 40 quarters over the past 10 years is a very impressive record. So Q1 earnings are overall expected to be in line with the long-term averages, around 7% this quarter. And coming this week, next week actually, I will be writing to my paid subscribers about which particular stocks I am closely watching for consideration for my portfolio. I'm going to be looking at stocks that did well in Q4 and have piqued my interest going forward. I use my Beachman scoring algorithm to score earnings reports and fundamental performance for stocks. I do that on a quarterly basis, and I publish these scores to my paid subscribers. So I'm going to be looking at stocks that scored well in my scoring algorithm and those that did not score well, and why. I've got reasons, I've got pros and cons for each of these stocks, and the pros and cons that factor into the actual score that I give the stock. And I also look for stocks that have improved the most over the past 2 to 3 quarters. And I've been doing this for the past 3 years or so. Using this data, I've actually demonstrated how the higher scoring stocks tend to provide the best returns over time. And the stocks that pivot from lower scores to better scores also provide superior returns. So as we get into the meat of the Q1 earnings season, starting next week, it'll be interesting to see which stocks actually raise and beat, as they say, their top line sales and their forward outlook. Now let's shift our attention and talk about the cybersecurity market. Cybersecurity continues to be in the news these days. Most recently, we heard news about United Health Group. United Health Group was hit by a major ransomware attack, which literally shut down their healthcare payment operations for weeks on end. Now, the cybersecurity industry continues to grow rapidly. According to August research, the largest number of security breaches in recent years have forced both businesses and governments to invest heavily in cybersecurity services. Cybercrime has cost the world an estimated $6 trillion in 21, and that's almost 2x what it cost about 7 years ago in 2015. Cybersecurity Ventures, which is an online publication, they do some extremely important research on this industry, and they provided these numbers. Cybercrime cost about $3 trillion in 2015, and it 2x'd to about $6 trillion in terms of cost in 2021. Cybercrime today represents one of the largest transfers of wealth in the history of mankind. That's a really interesting statement, and it's true, because as these cyber crimes take place, there's the ransomware that typically needs to get paid if you want access to your systems. I talked about United Health Group recently being a victim of one such cybercrime. It's rumored that they paid a ransomware, a crypto ransom of about $22 million to the perpetrators to get their systems and databases back online. Again, this is a rumor, and I don't have any way of confirming it, but it's certainly a rumor that's out on the street. So cybersecurity is becoming more and more important for both businesses and governments around the world. The cybersecurity solutions market consists of companies that provide solutions in terms of hardware, software, and services. And this is estimated to be about a $170 billion TAM, or total addressable market, around the world. This TAM is expected to grow at a 10% CAGR, at a 10% compounded annual growth rate for the next 5 to 10 years. So if you're a tech investor, if you like investing in the tech sector and in technology stocks, investing in cybersecurity cybersecurity stocks is certainly something to consider. Now, as far as I'm concerned, there are just about a handful of key cybersecurity players. You've got CrowdStrike, you've got Zscaler, SentinelOne, and Palo Alto. Now, Microsoft also has a very large cybersecurity business, but they don't break out their cybersecurity business numbers when they report their quarterly earnings. So it's hard to get a handle on how much money Microsoft is actually making in the cybersecurity space. The other aspect of Microsoft is they tend to give out a lot of these services for free, included in the enterprise licenses for the other software that they sell to their enterprise customers. So Microsoft is a large player, but we have no idea how large they are in today's world. But those 3 or 4 names that I mentioned a few minutes earlier, those are certainly some of the best companies to consider in the cybersecurity space. Now, shifting our attention but staying in the technology lane, there's a lot of talk these days about the upcoming halving event in the Bitcoin crypto land. The Bitcoin halving event is coming up. It's probably happening in the next few days, actually. Analysts have gone back and forth on what this actually means for the future of the value of Bitcoin, whether we're going to see a rally or a dip. Now, what exactly is this Bitcoin halving? Bitcoin halving is a quadrennial event, meaning it happens about once every 4 years. Bitcoin halving is a quadrennial event when the cryptocurrency's underlying blockchain cuts in half the availability of new rewards for mining on the blockchain. Now, the way blockchains work is that about every 10 minutes or so, all of the computers that are connected to that blockchain network, they're in a race to be the first one to solve a very simple but time-consuming math puzzle. And the winner, the computer that solves this puzzle the first, gets to add the latest block of transaction data to the blockchain. If you think about a blockchain, it's really just a network database on which new transaction transactional data keeps getting added to that blockchain database as these transactions are processed. And so the winning computer, the computer that solves that math puzzle first, gets to write to this blockchain network database, gets to write the latest set of transactions. And in return for the work that they did, in return for the work that that computer did in solving the problem and writing these transactions to the network rewards that computer with a newly created Bitcoin and some fees in exchange for that work as well. So this work allows, this whole process allows the blockchain to be used to store and process, to store data and perform calculations. So miners are these large technology companies that have hundreds and thousands of computers that are connected to the blockchain network. And these miners their computers are working hard to try to solve that mathematical problem. And they try to be one of the first to solve the problem so that they can win the award. Now, what's happening is during the halving process, after the halving is executed, the reward that these miners are given for their work is reduced by 50%. So after this month's halving, the block reward will shrink from about 6 Bitcoin, which today is worth around $380,000, I think. So the block reward will shrink from about 6.25 Bitcoin down to about 3.125 Bitcoin. So instead of being paid about $380,000 worth of Bitcoin, the miner that solves the problem will only get paid about $190,000 in terms of that reward. So miners are going to be earning half of what they used to earn before, but they still have to do as much work to earn that 50% reward. So in essence, in order to stay flat in terms of their revenues and profits, they have to do twice as much work as they used to before in order to earn the same amount of Bitcoin. Now, why does the blockchain have this halving event every 4 years? Well, there are only about 21 million Bitcoin in the world today. And as the Bitcoin blockchain is being used, Bitcoin is being given out in terms of rewards to these miners for the work that they're doing. By conducting a halving process every 4 years, the Bitcoin blockchain ensures that it doesn't run out of Bitcoin to give out as rewards, that it doesn't run out of Bitcoin for several more decades. It's really a process of extending the amount of Bitcoin that's available to give out as rewards for using the Bitcoin network. Now, the immediate impact to miners, as I said earlier, they're going to be doing the same amount of work but earning less Bitcoin. So there's going to be a drop in the revenue that these miners earn. The halving will cut in half the amount of new Bitcoin that's generated by the blockchain and rewarded to these miners. So about 900 Bitcoin per day is given out today in rewards, but after the halving, only 450 Bitcoin will be given out per day. And at the current prices, that amounts to about a $10 billion decrease in annual revenue that miners can earn. So there's certainly going to be a reduction in revenues for these miners. Now, there's also going to be a reduction in profitability for these miners. If they want to keep earning the same amount of Bitcoin that they used to before, they have to do more work. So miners with the lowest mining cost or the lowest cost footprint are going to have an advantage after the halving event. For Bitcoin enthusiasts or buyers, the slowdown in the rate of BTC that's coming available on the network, that's going to be a little bit of a dampener. So if you're a hodler, if you want to see more Bitcoin supply in the market so that you can buy it at lower prices, you're going to see a bit of a slowdown in that supply growth or the supply rate of Bitcoin going forward. How are miners preparing for the halving? Well, like I said, they're going to be earning less rewards for the same amount of work. So miners are trying to get as efficient as possible in advance of the halving event. They are seeking more renewable and cheaper sources of energy. There are miners that are acquiring smaller miners in a race to acquire as many mining machines and mining operations as they can on the cheap. They are trying to build more powerful and more energy efficient systems within their current operations. Miners are really doing anything they can to remain more competitive in the new world after the halving takes place. So miners have invested billions of dollars in acquisitions, in new mining operations, in new energy efficient operations in advance of the halving. Bloomberg, in fact, reports that miners have been raising billions of dollars to fund this growth, to fund this change in operations. They've been raising this money both in the public and in the private markets. One major mining firm called CleanSpark, this is a miner that I closely track, CleanSpark recently purchased over 100,000 new machines that are more powerful and more efficient than the computers they owned before that purchase. Crypto miners have typically relied on cheap and renewable energy to power their operations, but now AI data centers are also competing for those very same sources of cheap and renewable energy. So AI is competing against crypto miners for that energy, and it's creating a bit of an energy crunch, or it's expected that there's going to be some sort of energy crunch in the near future. I mean, the AI sector has deeper pockets, certainly has deeper pockets than the crypto miners. It's as per Bloomberg, the AI sector is willing to pay up to 3 to 4 times what Bitcoin miners were paying for the same electricity last year. So as a result, the cheap long-term energy contracts that miners had in place, it might be a little bit more difficult for them to find those cheap long-term energy sources in the future. Another recent development that could be bullish for Bitcoin, in fact, that could send prices higher, is the fact that we learned earlier this week that in Hong Kong, they recently approved spot BTC exchange traded funds to become available for purchase in Hong Kong. 3 financial firms in Hong Kong announced this news Monday that they had received conditional approval to offer spot Bitcoin and even Ether ETFs to investors, and they should start trading those fairly soon. Now, last year, Hong Kong implemented a new set of crypto regulations, and what Hong Kong's really trying to do is to become a regional crypto hub in Asia. And there's a bit of a dichotomy here because Hong Kong is part of China, and China has banned the purchase and sale of cryptocurrencies among its population. But it allows cryptocurrency to be traded in Hong Kong. As per Bloomberg, Hong Kong is also mulling another batch of applications to expand its roster of licensed digital asset or crypto exchanges. And it's also working on a government approval for a framework for trading stablecoins as well. So a lot of new developments happening in the Southeast Asian region of the world where that could be bullish for both Bitcoin and crypto over the next few weeks. So we'll see what happens both from the halving event as well as soon as these new Asia-based ETF products are available. Now moving on to our next story, we're going to talk about Apple and AI. According to Evercore research, analysts at Evercore continue to believe that Apple will ultimately become an AI winner. Apple researchers recently published a paper that detailed Apple's latest innovations in the AI space. They have actively been working on an LLM, a large language AI model called ReLM, Reference Resolution as a Language. Hold on, let me say that again. ReLM, Reference Resolution as Language Modeling. Apple has indicated that this ReLM LLM model is a much smaller model, and it's actually specifically designed to work on mobile devices. Apple has indicated that these ReLM models are performing similarly, if not slightly better, than ChatGPT-4. And it also is able to provide this level of performance with fewer parameters, with fewer data parameters. So Apple is very specifically designing and testing these models to make it more suitable to run on the edge on Apple devices rather than to run in an AI cloud data center. This could be signaling that Apple is primarily focused on delivering AI on their mobile devices, on iPhones, on iPads, and perhaps even on their Apple Watches. According to analysts, according to Evercore, this new technology will be integrated into Siri to improve the overall performance of the Apple iOS operating system on all their devices. Some of the key innovations appear to be around what's called reference resolution. Reference resolution refers to how the AI model or the AI engine can really understand references to on-screen data and what the consumer is actually doing with that device at that time. So the AI engine is supposed to be smart enough to understand how the consumer is using the device at any point in time, the data that's available both on the screen and within the device based on how the consumer is using the device at that time. So what Apple is doing is it's collecting this data and it's converting that data, it's converting that on-screen data into text. That text is then fed into their Realm LLM, and therefore the AI model is able to understand what it needs to do given the certain set of situations that it's facing, and it's able to support the consumer at that time. So this is the key feature that will enable Apple to deliver a high performance with a limited number of parameters. Remember, AI on the edge, AI on the mobile device has to be done, one, fast, it has to be done with less data, and it has to be done with the computing power that's available on that mobile or that edge device at that time. It's very, very different as compared to doing AI within the data center, within the cloud, where you've got access to immense deep pockets of processing power. So AI on the edge is a completely different game, and Apple seems to be making some significant progress along these lines. Apple could be one of these sleeping AI winners that nobody's paying attention to. If they're able to solve this on-the-edge, on-device inference challenge using their Realm LLMs, they could be the winner in the AI on the edge space. And this could, in fact, enable a completely new iPhone upgrade supercycle, a completely new mobile device upgrade supercycle. Apple has had Apple has had a challenging 2024 so far. The company's stock is down about 16% from the all-time highs in December of last year. They're also facing regulatory pressures in the US and Europe as well as in several other regions around the world. We continue to get news that their sales are down in the all-important China market, and that is putting some downward pressure on the stock. Apple is also actively diversifying their manufacturing supply chain, their manufacturing base away from China and into new regions like Vietnam and India. So Apple is almost, it's like they're trying to fly the plane and build it at the same time. It is totally imperative in my mind that Apple gets AI going within their company as well as within their products. And they've told us that at the upcoming June WWDC conference, which is their worldwide developer conference, at this upcoming June conference, they have promised many important AI updates. So we will for sure be tuning in to this conference. I think everybody around the world will be tuning in to the WWDC conference this June to hear what Apple can tell us. Consumers are tentative about the impact of AI on their lives. Consumers are not sure what to make of AI. They don't fully trust AI. But on the other hand, Apple commands a very, very high level of trust among consumers today. Apple has arguably one of the best brands in the world today. People that use Apple devices seem to trust Apple in terms of their privacy. So if Apple is able to get consumer-facing AI right, this could be kind of a game changer in the AI on the edge space. Consumers are more likely to trust Apple with its AI products, given Apple's worldwide brand leadership and high level of trust within the consumer space. So if anybody can get AI for the consumer right, most likely it could be Apple. Let's shift gears again. I want to talk a little bit about China as our last major topic for this particular episode. Now, we all know that China's economy has been struggling recently. Growth has recently slowed down to just about 5%, or at least that's what the government is officially telling us is their economic growth rate. Now, 5% is good, right? 5% is nothing to sneeze at. 5%, a 5% growth rate is pretty good. It's twice that of the US, and China is the second largest economy in the world. But this year it is behind the growth rate of India. India has taken over the global leadership in terms of economic growth rate, and China has been struggling. China continues to try to find new sources of growth within their country, and it's really challenged on that front. We have talked about, and we know that there's a major real estate slump or property market slump in China. Many Chinese real estate developers have gone belly up, and those that are still around are really, really hurting. There is chronically, consumers have contracted in terms of their spending. There is a chronically low consumption now developing in the Chinese consumer space. Consumers are not out there spending loads of money. In fact, it's estimated that Chinese consumers have saved up about $1 trillion in their savings accounts today. This is much, much higher as compared to pre-pandemic levels when they were spending more freely. So consumption is low. Unemployment is very, very high, especially among the youth. Unemployment in China is estimated to be somewhere around 15 to 18% among the younger sections of the population. And China's image around the world continues to deteriorate as, one, their growth rate has slowed down as they continue to get into bombastic verbal conflicts with Western countries. So as per Bank of America, China is really struggling to try to find new sources of growth. And China has launched a new growth strategy that's all about doubling down on manufacturing. Now, manufacturing has been down in China, but it seems like they are doubling down on that manufacturing sector in order to grow themselves out of an economic slump. China is focused on manufacturing and exporting renewable energy products like solar panels, lithium-ion batteries, and electric vehicles. China already produces and exports a variety of consumer products from hairbrushes to nail cutters to clothes to furniture to kitchen appliances, etc. But now they're turning their attention to exporting more clean energy and renewable energy related products. China's manufacturing trade balance has soared about 40% since 2019. They have increased their trade balance by about 40% based on these kind of manufacturing exports. Exports of electric vehicles from China, in fact, rose 70% in 2023 itself. So China is really doubling down on this strategy of manufacturing renewable energy and clean energy products and exporting them around the world. China's exports to the developing world have grown 51% over the last 3 years. These exports grew about 19% to the US and only 15% to the European Union. So China's exports to these developing nations seem to be growing 2 to 3 times that of their exports to Western nations. Now, for the US, the main concern about China's export-led growth strategy like this is the negative impact that it could have to the US's manufacturing base. Now, certainly, as more of these products are imported into the US, it's good for consumers because it increases the level of competition, it increases the variety of products that are available to consumers, and generally it should be bringing prices down. So that's all good for consumers. But it's certainly not good for the US's manufacturers that produce the same kind of products, because now they have to compete against more cheaply produced Chinese products, even if they have the same level of quality as compared to the products produced here. For example, it costs about 60% less to produce a solar panel in China as compared to the US. So US manufacturers of solar panels have to compete against this 60% lower cost production cost effect in terms of their pricing. The average EV that's made in China, for example, sells for less than half the price of an EV produced in the US and Europe. So China seems to be on an economic collision path with the US and Europe and with several emerging countries as they try to export their growth around the world, as they try to increase or improve their economic productivity, their GDP growth rate, and they export that growth to countries around the world. Certainly, what also plays into this is the fact that about 50%, I think it's about 45 to 50% of the world's population is going to be electing new governments in their countries this year. 2024 is a major year of elections around the world. And as about 45 to 50% of the world's population goes into the election booth to elect their new governments, they are going to be hearing a lot more political messaging around anti-Chinese imports. So lots more to come on this front. Another really interesting geoeconomic effect that's playing out in 2024. So what's coming up in the markets over this upcoming week? Well, on Thursday, April 25th, we will get an update on how the US economy did in terms of its Q1 GDP growth. Analysts are expecting GDP growth of about 3% in the US in Q1. On Friday, April 26th, we will get the updated PCE inflation report for the month of March. Now remember, the PCE inflation report, this is the Fed's favorite inflation report. So markets will be tuning in very closely to what the PCE inflation report tells us about inflation. Any numbers that come in lower and closer to the Fed's 2% rate will be taken as a positive sign for future rate cuts. Any number that comes up higher than the 2% rate and further away from previous readings will be negative for markets. So that's on Friday, April 26th, the PCE inflation report. That same day, we will also get the University of Michigan Consumer Sentiment Report for April. The University of Michigan Consumer Sentiment Report is one of the most widely followed consumer sentiment report. It's highly regarded as a true barometer of the health and mindset of the consumer in the US. And then the following week on April 30th to May 1st is the next US Fed's meeting. Chair Powell will provide his announcement on what they decided at the meeting, and he will also hold a press conference, as he usually does, on Wednesday, May 1st. So Tuesday, April 20th and Wednesday, May 1st are really key dates for all you Fed watchers, and we will certainly be tuning in. And that same day, Tuesday, April 30th, we'll get the ISM Manufacturing Index report for the month of April. This is one of those leading macro indicators that I closely follow. If you remember, the ISM reading for last month came in higher, above the 50 level mark, denoting perhaps a new expansion in manufacturing in the US. So that's all I have for this episode of the Market Whispers podcast. Do drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.